The Federal Reserve, America's central bank, made a big decision recently. This decision is crucial as it affects the entire economy, influencing everything from the stock market to the cost of borrowing money for consumers and businesses alike. The Federal Reserve's actions are closely watched by economists, investors, and policymakers around the world. They decided to keep interest rates unchanged. This means that the cost of borrowing money will remain the same for now, which can have various implications for different sectors of the economy. For instance, businesses may find it easier to finance new projects, while consumers might benefit from stable mortgage and loan rates. This is the third time in a row they've done this. By maintaining the current interest rates, the Federal Reserve is signaling a cautious approach to economic policy. They are likely waiting to see more data before making any significant changes, ensuring that their decisions are well-informed and balanced. The decision comes amidst a lot of uncertainty in the economy. Factors such as inflation, employment rates, and global economic conditions are all playing a role in the Fed's cautious stance. The central bank is trying to navigate these complexities to avoid any sudden shocks to the financial system. The Fed's benchmark interest rate will stay put at 4.25% to 4.5%. This range is considered moderate and is aimed at balancing the goals of promoting economic growth while keeping inflation in check. By holding the rate steady, the Fed is attempting to provide a stable environment for economic activities. This rate impacts borrowing costs for everything from mortgages to car loans. For the average consumer, this means that the interest rates on their home loans, car loans, and even credit cards are likely to remain stable. This stability can help households plan their finances better and make informed decisions about big purchases. Holding rates steady suggests the Fed is taking a wait-and-see approach. They are carefully monitoring economic indicators and trends to determine the best course of action. This approach allows them to be flexible and responsive to any changes in the economic landscape. They want more time to assess how current economic trends play out. By doing so, they can make more accurate predictions and implement policies that will support long-term economic stability and growth. The Federal Reserve's decisions are always made with the goal of fostering a healthy and resilient economy. The Fed's decision comes against a backdrop of growing concern about stagflation. Stagflation is a nasty combination of economic stagnation and high inflation. Imagine an economy where prices are skyrocketing, but businesses are struggling and people are losing their jobs. That's stagflation in a nutshell. It's a tough situation for policymakers to deal with because actions to address one problem can worsen the other. The Fed is clearly aware of this risk and is treading cautiously. One of the biggest uncertainties looming over the economy is President Trump's trade policy, specifically his decision to impose tariffs on goods imported from China. Tariffs are essentially taxes on imported goods, making them more expensive. While the Trump administration argues that tariffs are necessary to protect American jobs and businesses, many economists warn of their potential to harm the economy. Tariffs can lead to higher prices for consumers, reduced business investment, and slower economic growth. So, how is the U.S. economy actually doing? Well, it's a bit of a mixed bag. Some indicators suggest strength, while others flash warning signs. For instance, the economy actually shrank slightly in the first 3 months of 2025. That's never good. On the other hand, the unemployment rate remains low, and businesses are still hiring. Inflation is also relatively in check, hovering near the Fed's target. However, the tariffs could push prices higher in the coming months. It's a delicate balancing act. So, how did the stock market react to the Fed's decision to hold rates steady? Initially, there was a bit of a dip. Investors don't like uncertainty, and the Fed's wait-and-see approach didn't exactly inspire confidence. However, the market quickly recovered, and the major stock indexes ended the day higher. It seems investors are taking a deep breath and waiting to see what happens next. The Fed's decision was largely anticipated, so it didn't come as a huge surprise. Section 6. Trade War. Tremors, uncertainty grips businesses amid tariff threats. One of the biggest challenges facing businesses right now is uncertainty. Specifically, uncertainty about the future of U.S. trade policy. The ongoing trade war with China has created a lot of volatility in the market. Businesses don't know what to expect next. Will tariffs increase? Will there be a trade deal? This uncertainty makes it difficult for businesses to plan for the future. It can lead to delays in investment and hiring. Section 7. Global Monetary Policy. A divergence in strategies emerges. The Federal Reserve isn't the only central bank grappling with economic uncertainty. Central banks around the world are facing their own unique challenges. Interestingly, many central banks are actually moving in the opposite direction of the Fed. For example, the European Central Bank recently cut interest rates in an effort to stimulate their sluggish economy. This divergence in monetary policy reflects the different economic conditions and risks facing each region. Section 8. Investor Sentiment. A cautious optimism despite trade war clouds. So, what's the overall mood among investors? It's a question that doesn't have a straightforward answer. The sentiment in the market is a complex tapestry woven from various threads of optimism and caution. Well, it's a bit of a mixed bag. On one hand, you have investors who are buoyed by the strong fundamentals of the U.S. economy. They see robust job numbers, steady consumer spending, and corporate earnings that continue to beat expectations. On the one hand, there's a sense of optimism that the U.S. economy remains fundamentally strong. This optimism is not unfounded. It is backed by data and trends that suggest a resilient economic landscape. However, there's also a great deal of caution due to the ongoing trade war and other global uncertainties. The trade war, in particular, casts a long shadow over the market. Tariffs and trade barriers create an unpredictable environment that makes investors wary. Investors are essentially hedging their bets. They are diversifying their portfolios, seeking safe havens, and being more selective about where they put their money. They're not throwing money at the market with reckless abandon, but they're not running for the hills either. This cautious approach is evident in the way they are managing their investments. But they're not running for the hills either. Instead, they are taking a measured approach, balancing their portfolios to mitigate risk while still seeking opportunities for growth. It's a delicate balance between risk and reward. Investors are walking a tightrope, trying to navigate the complexities of the current economic landscape without falling into the traps of either extreme optimism or excessive caution. This balanced approach is what defines the current investor sentiment. Section 9. The Road Ahead, Data Dependence, and the Fed's Balancing Act. So, what's next for the Federal Reserve? This is the question on everyone's mind as we navigate through these uncertain economic times. The Fed's decisions are crucial, not just for the U.S. economy, but for the global financial landscape as well. Well, they've made it clear that they're going to be watching the economic data very closely. Every piece of data, from employment numbers to inflation rates, will be scrutinized to make informed decisions. The Fed's approach is highly data-dependent, meaning they will adjust their policies based on the latest economic indicators. They're not going to raise rates prematurely, as doing so could stifle economic growth. However, they are also acutely aware of the risks of letting inflation run too high. It's a fine line to walk, and the Fed must tread carefully to avoid tipping the scales too far in either direction. But they're also not going to hesitate to act if they see signs of inflation picking up. Inflation can erode purchasing power and destabilize the economy, so the Fed is prepared to take swift action if necessary. This could mean raising interest rates to cool down an overheating economy. It's a delicate balancing act. The Fed needs to support economic growth while also keeping inflation in check. This dual mandate requires a nuanced approach, balancing the needs of a recovering economy with the potential risks of inflation. The Fed needs to support economic growth while also keeping inflation in check. Their decisions will have a major impact on the U.S. economy for years to come. The policies they implement today will shape the economic landscape of tomorrow, influencing everything from job creation to consumer spending. Their decisions will have a major impact on the U.S. economy for years to come. Buckle up, folks. It's going to be an interesting ride. The Fed's actions will ripple through the financial markets, affecting everything from stock prices to mortgage rates. Investors, businesses, and consumers alike will be watching closely, anticipating the Fed's next move. It's going to be an interesting ride. As we move forward, the Fed's Balancing Act will be a key factor in determining the health and stability of the economy. Stay tuned, as the road ahead promises to be both challenging and fascinating.